this is Abhijit Chatterjee recording our weekly session of Chartsarefun. This is for the week of September 1st, recording this on Sunday, September 7th. Well, this was a very interesting week with the labor non-farm payroll data that came out on Friday, September 5th. Market was taken by surprise with the weakness in the employment. We know that the employment has been weakening. Chair Powell in his Jackson Hole did allude to the fact that the weakening employment causes him to shift the policy stance towards a rate cut. And now market is quite confident that there is a rate cut coming on the FOMC meeting in September 17th. So we look at the impact of the non-farm payroll weakening. The expectation was for 75,000 jobs. We ended up getting only 22,000. Unemployment for 3 steady months kept climbing. So from 4.1, 4.2 into 4.3. So August was 4.3, July was 4.2, and June was 4.1. So turned out to be a turning point from June onwards. In fact, June's jobs was revised negative. So it was up 14,000 previously, now revised 27,000 lower jobs at negative 13,000. So the market was quite nervous seeing the negative job print in June. We'll show you the non-farm payroll additions over the last 3 years to give you a trend that it has been steadily coming down. So the employment is weakening. We'll look at the 2-year Treasury. That in many ways signals what the Fed's rate cuts are going to be over this year and into next year. We'll see what that chart is telling us. We'll then look at gold. We know that gold has been on a tremendous climb. It has a nice breakout, key breakout, and we'll see where that gold breakout is headed. Look at gold miners as well, GDX. And then a direct beneficiary of lower rates ahead is Homebuilders. We'll look at the S&P Spider Homebuilder XHB. We'll look at small caps that also benefits quite a bit from lower rates. We'll look at what the Russell 2000 ETF IWM is telling us. We look at Bitcoin, of course. Last week, we made a bold call that we feel that Bitcoin could have kind of had its front-loaded its correction in August, and moving into September could start coasting higher. It did reverse from a bottom formation around 107,300, tested 113,400, and then pull back. We think it's looking bullish. We think it will likely reverse higher. So we look at Bitcoin chart. And then we will end with a look into volatility, VIX, which is kind of a fear gauge. And from VIX, try to read what we think S&P 500 could be doing in seasonally the weakest month of the year, which is September. So with that, let's go right into our Substack site, chartsarefun.substack.com. We appreciate you subscribing to it. It's free. As soon as the blogs come out at 7 a.m., you'll get it on your email. Our YouTube site is also Chartsarefun, youtube.com/Chartsarefun. Appreciate you subscribing to our channel. And if you like the content, if you could please hit the like button, we really appreciate that. And as I said, I'm going to go start off with the discussion on non-farm payrolls. This is a bar chart or a histogram showing us since 2021, the last literally we can see it's over 4 years, what the number of jobs that are added for every month. It's a monthly print every month that it gets added. So we see the highest print was towards right after, when this was not so much of new jobs being added, jobs coming back from what was stopped from COVID. We saw numbers as high as 850,000 or higher, up to 875 in the late 21 into 22. And since then, we can see steady decline of jobs. The black was the red, means if month over month jobs went lower than the previous month, then it gets colored red. So for 3 consecutive months in late 21, we see that the jobs started coming down in terms of the jobs being added. So they were red, and then when it goes back up, it goes into black. So it's basically the direction of coming down is red and going higher is black. So in the 2025 timeframe, we can see that from the March print of 185,000 jobs, starting April, we started weakening to the point where this print in June, this has not been updated by stock charts, but that 14,000, if you look at the BLS site, it clearly says that they revised the June employment in terms of the number of jobs added by 27,000 on the downsides. From plus 14,000, it went to minus 13,000. And so July slightly went higher from 73,000 to 79. So net 27, 20, and 6,000 21,000 net lower jobs between the month of June and July. So we can see that. And then this 22,000 was way lower for the month of August than what the market was expecting. So the market did not like the fact that initially it went higher, but then from there we show what the S&P 500 did after the initial gap up on the news. Because here, this is almost a situation where bad data, you would think market would like it because this confirms a rate cut, so bad data is good for the market. But at the same time, if this is indicating recession, this is indicating a slowing down of the economy, perhaps the Fed is too late. There was a lot of criticism from Trump's administration and from famous economists like Mohamed El-Erian and others on the Fed acting too late. And perhaps now that the Fed may come in and start doing rate cuts may not be enough for helping the economy from steering off into a recession. Now, if you look at the 2-year Treasury yield curve, this is showing you a weekly, every bar or every candlestick here is a week of the 2-year Treasury's range. And we can see that it's kind of forming a head and shoulder with a 3.55 neckline. So 3.55 went up to 508, went to 5.25, came back towards the 3.5, put the right shoulder is lower than the left shoulder. The left shoulder is at 508, the right shoulder was as high as 4.43. This breakdown from 3.55 to 5.25, you're talking about 170 basis points. So if you subtract 170 basis points, so 3.55 to 5.25, 170 basis points, that's literally 1.85. That's like 2-year yields below 2%. And that's almost talking about, look at the number of rate cuts, because 4.25 to 4.5 is where the Fed funds rate are. If the 2-year breaks down towards a level below 2%, you're talking about almost 250 basis points of cuts. That's a lot of cuts. That said, near term, there was several economists out there on CNBC and out in the news media talking about 3 cuts, 325 basis point cuts this year. So 25 into September, 25 into October, and then 25 in December. And then 3 additional cuts is what the market is thinking will be for the year of 2026. So a total of 6 cuts at 25 basis points is 1.5. And that brings us down towards the 2.75 level from a 4.25 that we're at right now. So 2.75 to 3 is where that range would be on the Fed funds rate. But this is something to be watching. If this breakdown does happen, we can see that the 50 period moving average is getting ready for a bearish cross. But the only thing that you would look at is the positive divergence. While the 2-year Treasury printed lower lows from 3.51 to 3.43, this week it tested 3.47. So while it's been hovering around here, RSI is actually at higher lows. So, and same thing with MACD. So that indicates perhaps something with respect to maybe inflationary concerns causes the Fed from not doing as many rate cuts as the market is thinking. But if these rate cuts do come and this breaks down, guess what's going to happen? Well, we'll look at Homebuilders and we think Homebuilders is going to take off. But importantly, gold, if as an indicator of inflationary concerns and also in a concerns of Fed having to do rate cuts, if you do rate cuts, what ends up happening is that the dollar weakens. And then when the dollar weakens, it impacts gold. Gold is inversely correlated to dollar. Gold shoots higher. So we can see this is the weekly chart of gold. And we can see a beautiful breakout above that 34.62 peak that gold had touched in the early June timeframe. This is an ascending triangle. The horizontal resistance level is at 34.50, 34.60. The low was 31.20. So 31.20 to 34.60, you're talking about 342 points. At the 342 to 3462 gets us to 3,804. So that's where we think gold is headed out of this ascending triangle. A beautiful breakout, 3.994% move in gold for the week. And that climb could continue. And that would mean the gold miners, which is GDX ETF, shows more upside. This also has a longer term chart. This is a multi-year breakout with the horizontal resistance level at 42.43. The lowest it touched was $11.33 in early 2016. Measure that from 11 to 43, you're talking about 32 points, right? 32 points added to 43.75. If you take 11.33 to 71, that's another, say, 38 points added to the 71. 76.09 is the precise target of where we already see an overbought level. RSI on the weekly at 81. We can see MACD is also overbought, overshot to higher highs from the past at 7.4. There is already a level of 66.87, 67, talking about another 10 points or so, less than 10 points. 9 points is what GDX could continue to climb. So this corroborates with the upside in gold. Gold from 35.87 is where it closed. Almost from there could climb up to 38.04, another 200, like 220 points or so in the gold, and that could mean GDX continues its parabolic vertical climb towards that. That said, when you look at gold and you look at this parabolic climb and look at how much the 50 period moving average has diverged from the 200 period moving average, that kind of huge divergence indicates potentially a possibility of a sharp pullback. Extreme overbought, extremely parabolic, and we can see negative divergence. As gold has been climbing, RSI is printing lower highs. Look at the level RSI was in 2024, October peak. Look at where it was recently, slightly lower than that. And this time, even when we hit 38.04, that RSI will be way lower than we saw in the April to May timeframe. So, and same thing with MACD. MACD will climb, but not much beyond the previous highs we saw at the April-May timeframe. So a lower high in MACD, a lower high in RSI with a higher high in gold at 38.04 to us would be kind of an exhaustion peak in gold. We are cautioning on gold. Yes, you could, if this rally continues, that's where we see gold climb to. We see there's a very good chance from the multi-year breakout of the gold miner GDX to get to 76, another $9 or so, $9 to $10 from where it closed. But beyond that, the very cautious vertical climbs don't end well. Expect a sharp pullback. And the way to play that is there is an ETF that is twice leveraged to gold on the bearish side called GLL. So for the time when gold reaches that 3,800, I would say it would be a great trade to buy GLL. You could perhaps hedge it with some other equities just in case gold continues climbing. But GDX could be a great way. So if a 10% pullback in gold comes from 3,800 back towards even say towards the 3,400 from where it broke out, that would be a 20% upside in GLL. It's twice X the inverse direction of gold. So that could be a good play, but not now. Let gold get to 3,800 and then look at that. Now I'm going to look at Homebuilders. We see a beautiful Elliott wave, 4 waves having completed and now about to start off, like about to break out onto a 5th wave climb. Each wave, as we see from the low and early, like during the COVID 22, went up to 83.86, pull back to 51, that is wave 2. These are intermediate waves. So wave 1, wave 2, then wave 3 went there to 125. The wave 4 pullback stopped beautifully at that 84 level. We can see 83.86 was the wave 1 peak. That's now, support because it was resistance before. It was right above at 83.86 at 84.35. It beautifully completed its wave 4. We think wave 5, this is yet to be, plotted out, could be a cup and handle. So 84 to 125, $41 added to 125, 166. That's where we think the Homebuilders ETF XHB is headed. Yes, negative divergence in RSI, not so much in MACD. MACD had a higher high. That indicates bullishness. We would need stronger volume after this cup and handle breakout happens. So a move to 125 in the next week or so, depending on what the Fed does. If Fed really does not act as dovish as the market is expecting, maybe a pullback. But then as the employment data keeps weakening, market is revert back to thinking of more aggressive cuts from the Fed. And that's when it breaks out. So till the FOMC coming in 2 weeks on September 17th, we get that 125 climb. kind of hit that resistance from the cup. Handle pullback comes when maybe the Fed isn't as, we know Chair Powell is extremely conservative with respect to rate cuts. He's very worried about inflationary concerns and so on. And he may just be careful and cautious in being too dovish in his statement, because there is in the Fed meeting every quarterly in June, September, March, what they do is the summary of economic projections, the dot plot. So they will share that, and they will kind of, that's perhaps why when we look at the 2-year yield, this is cautious, expecting that maybe the Fed may not be as dovish, and that could mean that this positive divergence could mean maybe 2-year yields may climb back higher again and not break down. But if the 2-year yields do break down, this home builder is just going to take off. We're going to straight, it may not even stop at 125 resistance, may not even do much of a handle, may just continue the climb to 166. Another thing that will take off is what many are expecting is small caps, but we are cautioning that the upside in small caps, at least the Russell 2000 ETF, is limited for the time being. We do have a beautiful inverse head and shoulder. The neckline is around 28209. The head is at 171. We've got the left shoulder to 196, 208.69. The head at 171, back to 209. Slightly higher right shoulder than the left shoulder, around 197, then broke higher. So 171 to 209, you're talking about 38 points. Add 38 to 209, 247. Look at the trend line joining the previous peaks from 2021, 2024 October, actually November, after Trump's victories when small caps shot up. And since then, in a like sharp waterfall decline came all the way. By the time the tariffs got announced and the tariff wars was at its peak, it fell to 171. Has been coming back, but that trend line is at a slightly higher high than the 243, right around above 245. It measures very close to that inverse head and shoulder pattern at 247. So we think this is what the small caps could kind of hit near term serious resistance. We don't expect it to break it. However, if that rate cut becomes aggressive, if, as we were saying, if the 2-year yield is going to break down from 3.5 and go to a 1.75, expect a mega rally in small caps. So that would be a beautiful cup from 170 to 40. You're talking about 78 or 77 points or so. That 77 points added to the 247 takes us all the way towards a 320 and higher. That could be a mega run in small caps, a big bull run in small caps. That's what the Trump administration would want. They're going to, of course, replace the FOMC chief next year. And maybe you do get a very dovish Fed chief, and maybe that's where the rate cuts come and break small caps higher. That said, near term, the resistance at 247 is where we think it might fail. We see a pullback. We'll see how shallow that pullback is. And then if the rate cuts become more clear, 2-year yield breaks 3.5 and goes towards 1 point, you're going to expect a mega run in small caps. I wouldn't jump the gun yet. Let it test its resistance, see how the pullback comes. Look at what the 2-year yield, because this is going to signal the breakdown. If the 2-year yield breaks below 3.5, and you start seeing lower lows in RSI, lower lows in MACD, that confirms the breakdown, then I would think IWM would be poised for serious upside. From there, Bitcoin, which is also interest rate sensitive, it is expecting a rate cut for sure if you look at what the pattern is telling us. This is a 4-hour chart of Bitcoin from that last peak from August. I think if you kind of hover over it, this was on August 14th. It hit 124,500. You can see a sharp decline. It tested 107,000 twice. However, it came right back up to a key neckline at 113,000. So this left shoulder, 113 to 108.7 to 113.5. Two double bottom test of 107,400, 107,300. Beautiful positive divergence from the 108 to the 107. Higher lows in MACD. And now we are poised to break higher is what we think. And if we break higher above 113, 107 to 113, you're talking 6,000. 107.3 to 113.4 is 6,100 added to 113,400, 119,500, which we have, in the past tested here, 119,300 and pull back. So that's a resistance level that it's going to go test. And then we believe this breakout continues further. In fact, if you look at the Bitcoin's weekly chart, and weekly cup and handle. This is a beautiful cup and handle on Bitcoin. 69 is the left brim of the cup. 15,500 in November of 2022 was the bottom of the cup. That cup right brim is 73,800, a shallow handle. 15.5 to 73.8 is 58,300. 58,300 added to 73.8 is 132,100. Guess what on the on that 4-hour inverse head and shoulder pattern? If we are headed from 107 and we are 107 to 113 is 119, but then if 107 to 119 then forms another cup, a handle and breakout, 107 to 119 is 12,000. 12,000 added to 119 is 131. So 131, 132 is definitely in the cards. We think in the next few weeks, by September or even early October, we'll get there. That said, we are worried about Bitcoin beyond there because we think Bitcoin typically has a cyclical peak and from there it starts coming down. And we would be concerned about Bitcoin. There are bullish calls on Bitcoin going as high as 150,000 to some calling 175. If it does stretch higher, sometimes it does stretch higher beyond technical targets, then that's awesome. And that can only happen when market thinks that rate cuts are going to be deeper than what's expected. And if that's the case, that 2-year yield breaks down, small caps are going to rally, Bitcoin will also rally massive. So that's something to be seen. But near term, we think in the next few weeks, this is a confirmed, almost confirmed, we'll see unless it breaks down next week, almost confirmed inverse head and shoulder. A break above 113 is our call towards 119, and then eventual break up to 131, 32 is what we think is in the cards. VIX, we're going to end it with VIX. We're going to look at near-term hourly chart of VIX. We can see in this case the cup and handle in VIX from 18.94 to 14.12 on the 28th of August, up to sharp rise up to 19.38. The cup is actually too deep for a cup, but it from there pulled back to 14.7, but a beautiful positive divergence in RSI. RSI, as we can see, slightly tilted higher, printing lower highs. MACD is also printing lower highs. Higher lows. Higher lows in RSI, higher lows in MACD, indicating positive divergence. And that indicates a break from 14 to 19. You're talking about 5. 5 added to 19 is 24. So VIX move towards 24 can't be ruled out. And if you look at the weekly chart of VIX, we can see that the MACD histogram is now tilted higher. And same thing, the signal line, black, is going to go curve and go above the red and start going from the negative region to the positive region, and same thing with the MACD histogram. That could indicate that we already seeing a pattern of higher lows. So from the 11.5 that we saw in 24, 12.7, recent low has only been as low as 14.12. We're not breaking down to the 12s and the 11s. So higher lows here. MACD histogram is gearing to cross above 0, and we can see that RSI is not breaking down to the 30s, is steadily staying in the 45 level, and from there going to make a move higher. So a volatility spike is potentially coming into 2026. We believe S&P could be signaling some form of a breakdown. Let's look at a very short-term chart of S&P, the hourly chart. This is a broadening top. The broadening top, in this case, we can see at the 6350, 6360 level is the horizontal support. The successive peaks are coming with negative divergence. So lower highs in RSI, negative divergence in MACD, confirming that this broadening top breaks down 6360 to 6532. You're talking about close to 172 points. Subtracted from 6360, that brings us below 6190, below 6212, the previous low we saw in early August. So we think that's the potential formation on the hourly chart. If you look at the daily chart of S&P, this is a bearish rising wedge. The joining the peaks, joining the lows, this is kind of converging towards an apex. Very crystal clear negative divergence, RSI is printing lower highs. We feel more and more confident that a bearish rising wedge breakdown in S&P is imminent into September. Typically, bearish rising wedge comes back to where it started from. In this case, the low end of the wedge is 6212. There will, of course, be some support initially at the rising. This blue line is the rising 50 period or the 50-day moving average at 63.50. We know that 63.50 has been twisted twice, but from a broadening top here, higher highs, the horizontal support breakdown brings us back to below 62.12 at 61.90, as we just showed you in the hourly chart. So this is a bearish pattern. MACD, the same thing, lower highs in MACD, as picture perfect as it gets, unless Chair Powell does something extremely dovish, like cuts 50 basis points maybe on September. That could have a negative impact though. If they do 50, market may get all worried that, oh, Fed is seeing something very negative in the economy in terms of a recession than what we rest of us are thinking, and market may start pricing in a recession, and that could also cause a bearish move. So you got to be careful there. But that bearish rising wedge indicates a breakdown and test towards 6200 is imminent in the next couple of weeks. We'll be raising cautionary signs on S&P 500. And then the another key barometer of a pullback coming is look at the S&P 500 on the top panel. This is the daily chart of S&P. We can see it climbing higher highs with that blue arrow. Guess at some of the indicators of growth that weaken before the market pulls back. This kind of additional climb is rotation, by the way. S&P did see sharp pullbacks in NVIDIA, but Apple, a very large triple $1 trillion market cap stock, is number 3. So you got NVIDIA, Microsoft. Microsoft has pulled back recently quite a bit, but Apple, Microsoft, NVIDIA pulled back, but Apple is going higher. Google in the Max 7 is going higher. So, and Amazon has also kind of steered up a bit higher from its recent lows. So those are helping rotate. Those are large mega cap stocks. Tesla has been higher as well, helping the market climb higher highs, but with weakening growth. So growth as in the Nasdaq 100 versus the S&P 500. Typically, you see that before the pullback comes, you start seeing in that ratio of NDX to SPX lower highs. So back in December, it peaked, the QQQ or the NDX to the S&P 500. Then it came into February at a lower high from the December peak, and then the sharp decline. Here again, it peaked all the way on August 12th. And from that peak, we can see that it is now steadily declining lower highs of QQQ or NDX to the S&P 500. The only caveat is we expect weakening of the discretionary XLY to the staples, XLP, because discretionary is the aggressive, staples is the defensive. That has not weakened yet, so that's climbing. But all other growth, the large, medium, and small, if you look at the Dow Jones growth, the G for the growth, and V for the value. So if we take the growth versus the value, L is for the large, M is for the medium, and the last letter S is for the small caps. Across the 3 areas of the market, the large, medium, and small, all 3 are giving leading indicators of growth slowing over value. When does value start outperforming growth? When a market pullback comes. So this breakdown of growth versus value in all 3 areas of the large, medium, and small sectors, and also in the Nasdaq 100 to the S&P, indicates a pullback coming. And what we are expecting is S&P will have this, breakdown from 65 towards the 6200, and then further we expect it to break 6200. So 62 to 65 is 300 plus points. Subtract 300 from 62, 4900. 5900 is, we know 5969 is where the 200 period moving average is. We believe it will slightly dip below it and test a 5900 in the next couple of months is what we think, before the market has another climb. So that's what we are watching. We would be careful into chasing stocks at this point. In summary, the non-farm payroll is showing a steady decline of jobs. Fed is now hence very concerned. It printed 22,000 jobs in August, way below the expectation of 75,000 jobs. There was negative revision of 21,000 net jobs, 27 negative revision for June, and 6,000 upward revision for July. Net 21,000 negative revision over June and July. Moreover, net jobs added in June was negative 13,000. That's a concern. 2-year Treasury yields is the detail of what the market could do. If this breaks down, that means the Fed is either getting extremely dovish, concerned with the economy, maybe trying to save the economy, and this could indicate, if that breakdown happens below 3.5, from the 3.5 to 5.25, 1.7. So 170 basis points subtracted from 3.55 takes us towards 185. So 185 is where this could come down, 1.85, and that takes us the Fed funds rate cuts of 250 basis points from 4.25 to 4.5 is where it is at. You're expecting 250 basis points of cuts if that's what the 2-year yield is going to break down to. That said, there is positive divergence in terms of higher lows in RSI as it's been testing the 3.5. So near term, Fed may not be as dovish, maybe still be data dependent, watching on the data and so on. And this could effectively then mean that 2-year yield could maybe get another upward climb. It probably may not break above the 5.25 unless some very hyperinflationary data comes and all rate cuts are off the table and Fed has no other choice but to start thinking about some rate cuts. Till then, however, this is something for us to watch. But till then, at least this positive divergence is worth the concern. But if the breakdown do happen, this is negated and RSI goes way below 30 and MACD breaks down to lower lows, that could mean significantly, lower rates, and that could actually be very bullish for small caps. Gold is broken out above 3,400, climbing to 3,800. We feel this breakout is long in the tooth, as in the climb is long in the tooth from 1,600 going to 3,800. That's like $2,200 climb in a span of just what, the 3 years, from 2022 September to 25 September. So in a span of 3 years, going from 1,600 to 3,800. So that 2,200 climb is almost like 130, like more than double. It's 133% or so. So very, very sharp climb. That will have a sharp pullback is what we do think. Gold miners had a beautiful base over multi-years between 11 and 43, broke out to 76, 75 is where the target is. Extremely overbought RSI, MACD. So once it touches that level, which could coincide with gold testing 3,800. So that gold 3,800 could be GDX at 76. We'd be watching out and look for a pullback. A way to play the pullback in gold is buying 2x short on gold called GLL. GLL could be a way to do. So if gold comes down 10% from 3,800 towards 34, that 10% can give us 20% upside in GLL. Homebuilders is poised for its fifth wave climb. We can see that wave 1, wave 2, wave 3, wave 4. Wave 4 is completed. Fifth wave measures to 166 based on a cup and handle. So 84 to 125 is where we think it'll hit near term. Maybe a pullback from there, a handle, and then a breakout. That 166 is where we think the wave 5 peak could be in XHB. That said, there is negative divergence with lower highs in RSI, and that's a concern that if you do hit that 166, RSI may not be as stronger than in the past, and that could then be a top, and then that's also a very big parabolic climb. Homebuilders would then have a very sharp pullback, something for us to look into. Small caps, near term is climbing towards 247.48. That's the rising trend line of the peaks. There's also the inverse head and shoulder from 171 to 209. That measures to 247, 248. And there we should then be cautious and expect a pullback. So a cup and handle could form from 171 to 248 and then a break higher. If that break higher does come, you're talking about 77 points added to 248. That brings us towards close to 325 or so. That could only come if the 2-year yield breaks down. If a 2-year yield breaks down towards below 2%, a lot of small cap kind of growth or breakout will come. One is we will start seeing big net interest rate margins. Banks will do extremely well with the big difference of net interest rate margins, and that could cause the regional banks to do well. It could also help bring they have a lot of paper losses in all these regional banks because of the Treasury yield shooting up. So if that coming down will help them. So regional banks could break out the small caps. The biotechs could do extremely well, and smaller companies do need to kind of go out and loan money to power their growth. So when money is becoming cheaper and more flush with liquidity, that small cap breakout is possible. Something for us to look into if we do see the 2-year yield break down below 3.5 towards the 1.85 level. Bitcoin Near term is a beautiful inverse head and shoulder on the 4-hour chart. 119 is coming. Then from 107 to 119, maybe a cup and then a breakout. So that's 12,000 to 119, 12 to 119 brings us to 131, 132. That's also its weekly cup and handle pattern. VIX, in our concern, is pointing to a spike ahead. Potentially a level of 24 might be tested. A cup from a 18.94 to 14.12 to 19.38. 14 to 19 is 5 points added to 19. Talking about 24.6 is where we think VIX could be climbing. VIX weekly chart is showing a bullish cross of the MACD above the zero line to on the positive side, the signal line in black breaking above the red. And that could mean we can see higher low patterns in VIX, 11.5, 12.7 to 14.12. We could see a VIX spike coming into next year. And that could also mean that perhaps what we saw in 2021 into 22, when we saw VIX climb and we saw that bullish cross of the 50 above the 200, we are poised for that as well. The 50 is now come higher, about to cross above the 200. Right now it's flatlining, touching each other, hugging each other, and just staying there. But if the VIX does break out, expect the 50 to go above the 200. A similar situation like 2022 could set up, and we are cautioning that there could be a cyclical bear market into 2026, where a 20% pullback of S&P from 6,500 to take us to 5,200, 1,300 point pullback in S&P couldn't be ruled out. So that's something for us to look into and be cautious about. S&P 500 near term, hourly chart has a broadening top. That breakdown from 65.32 will at least bring it down towards the 63.50. Further breakdown will bring it below 62.12 to 61.90, and potentially if it does break from 62 to 6,500, that's 300 points subtracted from 62 measures to 5,900 is potentially where we think VIX S&P could be headed. That's where the 200 period moving average is. This is the daily chart showing the bearish rising wedge, negative divergence with lower highs in RSI, lower highs in MACD. Almost a picture perfect indication of a breakdown in S&P coming towards 62 at minimum and then further down towards 5,900. And a leading indicator of what could be a weakness in S&P 500 and the markets is the growth sector, growth-oriented NASDAQ 100, when the ratio to S&P is underperforming, lower highs. And then all the large, medium, and small, three of growth was as high, we can see are printing downward declining trends as in lower highs, indicating that we could be setting up for a market correction in the next several weeks and months. With that, good luck investing. We'll talk to you next week. Thank you.